Hey guys, welcome to the August SIH Capital Group monthly webinar series. Actually, we're a few days early, so for the first time in a while, we're actually recording a little early. So excited to get this one off the belt. This has been about 10 months, 11 months since Andrew joined us last. He gave us a state of the market, so I thought it'd be good to have him back. A lot has changed in these 10 months. I think the pending Armageddon hasn't exactly happened like a lot of pundits have said. It could happen tomorrow. It could happen in 6 months, or it might never happen. So it'd be interesting to see Andrew's take on it. Ever since I was in Andrew's mastermind program, I take what Andrew says very seriously in terms of his opinion is very educated. I'll put it that much. So I know my investors always love hearing from Andrew. And without further ado, Andrew, thank you so much for jumping on.
Oh, good to be here again.
So let's get right into it. We're July 26th. I think we had another inflation data point come out today. I think it was a little more than was expected, but still the lowest in 3 years. All the signs point to the Fed holding on this one and signaling in some language that they might start lowering interest rates as early as September. Now, for the first time, Andrew, I don't know if you caught this as well. I saw an article actually saying it might be more than 0.25% and it might be 0.5%, which was interesting. This is the first time I heard that, and I heard that today. So interesting place where we are in the market. I know you follow a lot of this stuff. You always post amazing charts on LinkedIn. So where do you see us today as we're recording? You might see these clips later on in a month or two, but where are we today? Like, how is your company strategically navigating the macro environment, and how is that affecting your offers that you guys are putting out on apartment buildings?
Yeah, in terms of the Fed, can't even predict what the Fed does. If you look at their dot plots and all this, they're always way off from what they end up actually doing. So I can say that the markets are heavily betting on a September cut of 25 basis points. I have not heard any chatter about 50 basis points. I would personally doubt that they would do that, because that would send a message to the market that they might be panicking a little bit, or admitting that maybe they overdid it, or any kind of sudden move the markets don't like. And I think that would represent a sudden move. So I would be really surprised to see a 50 basis point cut. 25 maybe in September. I think markets are currently factoring in a 100% chance of at least one cut before the end of the year. Maybe one in September, one in December. But candidly, for the multifamily market, it ain't going to matter. Most fixed rate loans are based on the 5 or 10-year treasury, which are hovering just over 4%. And then the floating rate loans that are based on SOFR, that index is very closely tied to the federal funds rate. And candidly, most of the properties that are in trouble with those loans, 25 or 50 basis points isn't going to be enough to make a difference. They're still going to be upside down, underwater, unable to afford the payment. That's where we stand with interest rates and the Federal Reserve and all of that. So what were some of the other aspects you wanted to touch on there?
How is that affecting your appetite for deals right now? Maybe how is it affecting your underwriting?
Our appetite, we're starving. We've looked at 700 deals without buying one, mostly because seller expectations for pricing is still higher than what we're offering. And transaction volume in the multifamily space is actually lower than it's been in over 10 years, both in terms of units transacted, and the dollar value of the units transacted is actually slightly below the levels in 2014. And prices were a heck of a lot lower back then. So that's impressive to be lower than that dollar volume. So we are very much making offers. In the last 3 to 4 months, we've actually have started getting close on some. Previously, we might be 20, 30% off. Now, in a lot of cases, we're only off a couple of percent. We actually have had a couple of signed LOIs that got blown up for reasons outside of our control. One of them was an approved short sale, and then the lender changed their mind and decided they just weren't going to approve it. And 6 months later, everything's still in limbo, and the property's performance is just going down the toilet because no one's paying attention, because no one cares anymore. So with all that said, it feels like transaction volume is starting to inflect upward. Brokers that we talk to are saying they're doing a lot more BOVs, or broker opinion of value. And what that means is that means sellers are at least considering selling, right? Because they're reaching out and going to the broker and going, what do you think this thing's worth? It means they're at least thinking about it. And so that's a very much leading indicator that inventory may be coming. We are big believers that at some point, we thought it would have happened by now, but there's been a lot of extend and pretend and other factors. I do think there's going to be a lot of opportunity coming up. I'd say by the start of 2025, we are gearing up to acquire as much as we can in the next 12 to 24 months, because I think that's going to be worth a heck of a lot more than it is today by the time you get to 2028 and 2029. And yeah, so that's what we're doing. We've hired a couple more people. We've been streamlining operations and really hoping to acquire more in the next 12 to 24 months. I do think pricing declines in multifamily are done. On average, prices are probably down 20 to 30%. And there's some exceptions in some really distressed locations and markets. Class B and Class A, especially newer vintage, 1990 or 2000 and newer, I think pricing's actually already started to tick up a little bit in that segment. Class C or Class D, even though Class D doesn't exist, right? Because no one actually admits to owning or trying to sell a Class D property. Just the theoretical Class D. I think prices may have some further room to the downside in that space because cap rates haven't really expanded enough there. And a lot of those properties are going no bid, meaning an A- property built in 2015 in a good area is getting 30 offers, where a 250 unit 1972 property in a submarket with low incomes and high crime is getting no offers. Yeah, and so the only way you fix that is pricing has to come down further. I think you're going to see some potentially more downside in Class C and D. I think B and A is probably done unless we get another huge run up in interest rates. But other than that, there is so much pent up demand from buyers looking to acquire these assets that even if volume does significantly increase in the coming months, there's more than enough guys like me ready and more than willing to try to absorb those properties.
Yeah, you said a couple of really interesting things. One of them, you said that 2020, end of 2024, early 2025, you buy that asset by 2027, 2028, it's going to look a lot better. I love that philosophy. It's not saying that you're going to sell in 2027 to 2028. It's just the way that the environment is setting up. And I'm a firm believer in this. It's like my whole thing is if you could make the numbers pencil out at 6.5%, like on a couple of these recent deals that we've done, they're going to look a whole lot better if we see a low 5. And we're actually starting on this deal that we're in contract now. We already have an offer sheet, a finance offer sheet with a 5 in front of it.
We actually closed a $24.5 million refinance yesterday. 5-year fixed rate Freddie Mac, 2 years interest only at 5.82%.
I think that's the change that you start. I feel like this is the part it starts accelerating when you start seeing a 5 start printing. People start underwriting more aggressively. So I think you're 100% right. And that's why we're super excited about the acquisitions that we're getting into now, because we don't want to hold for, we're not flipping these properties. So in 10 years, they're going to look phenomenal. But in 3 years, they're going to look really good. So I think this is a great time for that dollar cost. And not a lot of real estate syndicators, they talk about like average dollar costing. It's, hey, even if you did a syndication during a 3 cap environment, as long as you do a syndication next year and the year after, and the syndication is fundamentally strong, you're going to be fine overall versus not trying to time the market and get the absolute bottom.
Yeah, as long as you're not in a deteriorating neighborhood, time is essentially on your side, which is rare in investments.
So I want to ask you then a question, and this is a personal question underwriting wise. 2018 to 2020, when you underwrite for cap rate expansion. I believe I remember the benchmark is usually 10 basis points a year, right?
Yep.
To me, I stopped underwriting it that way the moment interest rates ran to 6. To me, I feel like you're just pricing yourself out of too many deals at that point if you keep underwriting for cap rate expansion when interest rates are 6, 7. Is there a point where you guys start looking at it and say, you know what? Yes, interest rates might go up to 8, but most likely they're going to be stabilized either at this rate or go down because the Fed does have a mandate for a 2% inflation rate, right? Is there a point where you stop underwriting for that cap rate expansion?
There might be, but we haven't reached it yet, as far as we're concerned. Right now, the cost of debt is still significantly higher than the average cap rate in multifamily. That type of inversion is not something that typically would persist for a very long time. So that means either pricing has to come down, which means cap rates expand, or interest rates come down. I think it could be a little bit of both. So we still are underwriting the cap rate expansion because when we look at, and it's a bit of a hedging strategy, when we go forward on a kind of a macro high level picture, we think it's very low odds that cap rates are going to be significantly lower at any point in the foreseeable future. We've got so many secular inflation pressures, and people got way too used to the super low rates from the last 5 to 6. That's not normal. That was way below mean. And unless we get into a severe recession, which will cause its own issues, we're not expecting to see interest rates or cap rates at that point again, where you got B and A class assets trading in the 3s and low 4s. So we don't think cap rates really have a whole lot of room to go down further, at least not in the B and the A stuff. Our base case is that cap rates probably stay about the same for the next 3, 4, 5 years. Now, and the reality is we can't predict what the cap rates are going to be 3 months from now. But just so take this with an entire shaker full of salt. Basically the general principle is the odds of cap rates significantly moving back down again seem pretty low given the macro factors that are out there. There's a pretty strong case for them to just stay where they are, which is very workable. But there's also a non-zero, and I would almost say meaningful risk that cap rates are higher in the future. And cap rates, your exit cap rate is one of the biggest levers that goes into underwriting. And now, candidly, that's how a lot of sponsors put out pro formas that look great, but then eventually don't perform, is because it's based on an exit cap in 5 years. That's not going to happen. And so, yes, that will probably knock you out of deals, especially if the other guy's factoring in even or even to lower cap rates. But I'd rather regret the deal I didn't do than regret the deal I did do. And so, yeah, we're still factoring in cap rate expansion because it's a hedge against the worst case, which if you got a deal that works with cap rate expansion built into it, odds are you're going to be in pretty good shape because either way you win. If cap rates go down and you're wrong, you're going to be blowing your numbers out of the water. Cap rates stay the same, you're good. If they will go up, you already planned on it.
Yeah, and to be clear, I definitely won't underwrite for cap rates going down, but I feel okay at this point to underwrite cap rates staying stabilized, especially for a longer hold.
It depends on what your entry cap rate is too. I've seen some deals come across where they're factoring in cap rate expansion, but they're buying at a 4 cap and saying they're going to sell at a 4.5. It's like, I don't know. But if you're buying at if you're getting a great deal and it's a 7, is it reasonable to exit at a 7? Probably. So it's also a bit deal specific. So I'm talking very macro high level. And we say, we think they'll probably bounce around somewhere similar to where they are. But again, who knows? You could have all kinds of world and economic events that shift things.
Interesting. Yeah, and I agree with you. Just if you're gonna buy at a 2-3 cap, what is really cap rate expansion at that point? But if you're buying in that like high 5s to 7 cap rate, you're in a whole different situation because that's at least matching. You're not getting negative leverage on your money at that point. The other thing, it's interesting. I know you follow the rates. The 5-year and the 10-year just started diverging a little bit. Before they were almost neck and neck. I think today the 5-year is at 4.08, 10 years at 4.2. How does that influence? Well, I know you just said you just did the right refi of a 5-year refi versus a 10-year refi. How is that factoring in?
It's just it's that's more of your standard rate curve, right? Where the longer term rates are higher. That's how it typically is. We've had an inverted rate curve for a long time now, or historically longer than normal, where the shorter term was actually higher than the longer term. And that's starting to revert back. That what it does is it gives you kind of options to match your debt with your business plan. So like the refinance that we just completed, that's a property we've already owned for 3 years. Our current plan is to sell somewhere in the next 3 to 5. So it made sense to go ahead and get a loan that was based off the 5-year treasury, have it be 12 basis points lower because we plan on selling within 5 years anyways. Fixed rate loans have a lot of positives, and especially fixed rate agency, we tend to do a very high percentage of our properties with those loans. However, if you go to pay them off early, they can come with very significant yield maintenance, and which effectively is a prepayment penalty. So you have to be careful to match it with your business strategy. If you're going to sell something in 3 to 5 years and you put a 10 or a 12-year agency loan on there, you might be able to sell it on assumption down the road. But if not, and you end up paying that loan off, you're going to have huge prepayment penalties. Whereas we don't have a clear or strong conviction as to where interest rates are going to be 5 years from now, and we plan on selling anyway, we went ahead and said we'll lock in a lower rate, base it on the 5 year, and put a 5 year term on it. So
Makes complete sense. In terms of last time you guys acquired was last year.
Mhm.
Like in terms of when you guys do go through these stretches, do you guys just zone in on operations at that point? Because then the team is not divided between acquisitions, or since you guys are putting out so many offers, you guys still are pretty active on the acquisition side. Does it allow you to really zone in on operations during these time periods?
Yes and yes. So the acquisitions team is still very focused on acquisitions, but there hasn't been as much for them to even to look at. So the acquisitions team also helps out with refinances and does some support on the asset management side. So that's been really what we've been doing for the last year and a half, is doubling down on trying to enhance and improve our asset management skills, since that's where the money's really made in multifamily anyway. Assuming you buy it for the right price and have a good basis, and you put the appropriate debt on it, once those two fundamentals, or those two chunks of those lay the foundation, then you got to operate it well, and that's what really makes the money. And so we've been doubling down on that. We've hired a couple more people so that number one, we have the ability and the bandwidth to put more focus and energy into operations, but then also to create additional bandwidth so that when hopefully we start acquiring a lot more units, let's just say next year, we already have the bandwidth to do that and work them into the portfolio seamlessly versus get overwhelmed with a bunch of new acquisitions.
Andrew, is there an ideal like asset manager to properties ratio that you guys have?
I don't know if there is. Currently, it really depends on so many factors. So, for example, if you've got an asset manager, what's the travel time to each asset? Is that asset undergoing a major renovation, or has it been stabilized for 5 years? Because we've got properties that have been stabilized for 3, 4, 5 years that require very little time and attention. Whereas other ones that are still in the midst of the renovation, the reposition, we do weekly site visits, sometimes twice a week. And then there's weekly calls with the team, and then there's a renovation call with the team. So the amount of time and effort spent on that asset is literally 10 times what it might be on an asset an hour away that we've had for a much longer period of time. If you've got a really stabilized long-term portfolio, 10, 11, 12 properties might be pretty doable. If you've got more that require time and attention or in a reposition, might be 4, 5, or 6. It really depends. I know some property management companies, for a regional manager, which is like the management equivalent of an asset manager, they'll give those people 10, 12, sometimes 20 properties, which I think is too much based on based on the what we see actually happen when you get to those numbers. But it's 10 to 12 stabilized, maybe 4 to 6 not stabilized.
Do you guys have multiple asset managers on the same property, or it's that asset manager has properties A through C and then asset manager to has the next batch of properties? Or do you find it better to have multiple eyes on one property?
Yeah, so for right now, the entire asset management team is focused on, it just covers the whole portfolio, like whatever is needed when it's needed, or like whatever property, for whatever reason, we feel like deserves the most time and attention. As we hopefully grow significantly over the next few years, we will probably break it up geographically. For example, one of our our asset managers lives south of Atlanta. I could see her taking Florida and Georgia, and maybe somebody else takes the Carolinas and Southeast Virginia, or something along those lines. As we grow and expand, I could see a geographical division making sense. But yeah, we'll see when we get there. Who knows? We seem to always end up buying stuff in Georgia and Florida, despite trying to buy in the Carolinas. So
Are you guys in the Virginia area too? Or you guys look?
we've made offers there. We had an accepted LOI there. It got blown up. Again, that's something outside of our control. But yeah, we're Southeast Virginia, down to North Florida, and then Eastern Tennessee, and a couple of select submarkets in Alabama.
Interesting. Yeah, we are just acquiring our first property in Virginia as well.
Oh, okay, cool.
We'll meet halfway. So all your asset managers are local, or do some of them fly out from California to go visit the properties?
I'm the only one in California. We are kind of head of asset management actually lives in Nevada. And then everyone else on the asset team is local to Georgia.
Very cool. In terms of property management, this is something we did early on. Like we had that exact situation. Regional manager had 18 properties. We were one of them. We didn't have a sizable enough portfolio with them to really command like a dedicated regional manager. Performance was terrible. We're dealing with affordable housing because she would follow up with housing authority. Housing authority didn't respond. By the time she got back to our property a month later, she followed up with housing authority, and then we're like 90 days out before anything moved.
Yeah.
So we went our own property management company. I see that's like the recent trend the last 2 years. So many syndicators have gone their own stuff. I know you have a great relationship with your third party property. Any thoughts ever on bringing that in house, or you just focus on the asset management and that's it?
We focus now. The short answer is no. We have no intention of bringing property management in-house for a handful of reasons. I guess I can't say it'll never ever happen because you just don't know what circumstances can conspire. For some reason, the current company we're with went away, and we didn't feel like there's another good option, and we could find enough people. Maybe. Do we desire or have any intention of doing that? Absolutely not. But we use a hybrid approach where we do use the third party property management. They're doing all the day-to-day kind of headache, unsexy stuff of property management, filing evictions, collecting rent, payroll, HR, all this, just the day-to-day stuff, and a huge volume of day-to-day stuff that's required to run large apartment complexes. And then we see ourselves as more providing the vision, the direction for the property, serving and empowering the on-site teams, trying to make sure that the property manager and the maintenance supervisor has all the tools they need, all the equipment they need, the funding they need, the authority they need to get things done. Our job is to make their job as easy and effective as possible. And then I said, so we're very much involved where the third party property management company, they're handling all that admin day-to-day stuff I talked about. But we are at minimum weekly on a Zoom call with the on-site teams going over the weekly performance and the leasing and the collections and maintenance projects and renovation projects. And here's where we're trying to get. And here's like a little more than a year ago, we shifted from a focus on getting higher rents at renewals to increasing the renewal percentage, right? We just set a goal for the whole portfolio. Hey, we want at least 75% renewal rate, which is actually really high. That means if you've got 12 leases renewing in August, that means 9 of them renew and stay, and only 3 move out, which is pretty high. But yeah, that's how we do it. We use third party, but we are very much integrated into the process.
And did you change that KPI because of the construction costs?
No, we just did that as a defensive move heading into an uncertain economic environment where, there's a lot of expectations for a significant recession and economic weakness. That's what the Fed's trying to do, is slow things down. And so there's one of the big rules is don't fight the Fed. We tried to get ahead of the curve. And when it comes to a lot of properties, actually are seeing much higher vacancy now and flat to declining collections. And we wanted to get ahead of that and really just focus on keeping the people that we have in the unit. And then, like you said, what the secondary benefit that has is you don't incur the costs of turning the unit. Not only do you not have the vacancy, but you don't have to spend the time and the money cleaning it up for the next person who's going to come and lease it. That saves time for your maintenance crew. Now they can spend more time on preventative maintenance, and up to a certain point, it's a beneficial compounding effect.
And that strategy, you could only really apply that strategy if you own it for a certain amount of years prior. Like you can't buy a value add and go year one.
No.
Strategy, right? Your business plan would completely fall apart. So it is interesting to have that luxury because you own long term these properties.
Yeah, and that is one of the benefits of longer term ownership is you earn a lot of flexibility in a lot of different ways.
Let's switch gears a little bit to I think I want to touch on two more topics before we call it. One, supply. A lot of recent chatter data about that supply is going to tail off very soon, and then that again be a really nice tailwind for the industry. How close are you following that for your company?
We follow it pretty closely, and then, again, that's part of why I very strongly believe that by the time you get to 2027 and beyond, rents and values are going to be moving up significantly, because we had hit a generational high in deliveries last year, but now the pendulum has swung the other direction. Starts and new permits are way, way down, which means 2 to 3 years from now, there's going to be very little being delivered and supply is going to shrink. And if that's one of the benefits of commercial real estate investing, is certain aspects of the cycle are incredibly easy to predict because the leading indicators are 2 to 3 years out. So you can tell what's going to happen to supply and demand. So we see this current localized supply glut as very much an opportunity because it's very temporary. And then something else that's not getting talked about as much is the absorption this year has been huge. The fact that we've been delivering generationally high amounts of units, and yes, leasing's a little slower than everyone hoped and all that, but when you look at the absorption numbers, their demand is actually really strong. And if that demand stays anywhere close to where it is, and the supply goes back to normal and then below normal, it's going to create a squeeze in terms of affordability and availability. And so again, rents and values will be heading back up.
So interesting point that you made, I think, with the rent value. So I agree with the fundamental thesis is that supply is going to shrink. There's going to be this huge shortage, and then there should be this period of high rent increases. My concern is on the properties we bought in 2022, like we've had 30% rent increases in these last 3 years, and we're in the affordable housing space. And we're in a situation where housing authority isn't taking the brunt of it as they used to do, because they have their own budgets and they're complaining that they're not getting increased budgets. So our concern is that in 2-3 years, yes, the demand is going to be there. However, there is going to be a cap to, I don't think we could do another wave of 30% rent increases and still have tenants afford those properties. So I don't know. How do you feel like will the next period, this next 3 years, which will be great for supply and demand, however, are any concerns where the rent increases that we should get, we won't be able to get because of the last 3 years of rent increases that just went into effect?
Oh yeah, no, affordability is a huge issue, and that's actually one of our top factors that we use for screening properties, whether or not we'll look at them. Our goal is to make sure that our final rent is basically ideally 25% or less of the median income in the area. For example, let's just say, for round numbers that we can do in our head, let's say we're buying a property and hey, after renovations, we can get the rent to be $1,000 a month. That's $12,000 a year. So ideally, that property is located in a market where the median income is $48,000, meaning the median family can rent that unit and only have to allocate 25% of their income to cover that rent. That makes it affordable. That means a vast majority of people in that market can pay that rent, and there's room they can probably pay more if need be. The further down you get the chain, the bigger and bigger of an issue that's going to become. You're absolutely right. I think part of what you're going to see is, for one, I mean, here in the United States, we're spoiled. We're all used to all having our own giant units to ourselves at pretty much all income levels. You go to the rest of the world, that's generally not the case. Apartments tend to be far, and houses tend to be far smaller. There's multiple people living in them. And I think at the lower end of the spectrum is what we're going to see is a trend in that direction of more roommates, people going to smaller units for cheaper rent. And then on the flip side, yeah, I think we're going to have may have more issues with delinquency. The more unaffordable it gets, the more and more the whole rent control discussion is going to keep popping up, which will just make it worse in the long term. But people don't think long term. Politicians in particular think short term. So that is absolutely a challenge. Again, the way that we try to mitigate that is, number one, again, the affordability screening that I talked about a minute ago. And then also, if you move up the chain to B to A class, not the super luxury stuff, but just regular A class properties, where it's a little bit more renter by choice or lifestyle, where people are renting because they want to, or they at least have some more room in their budget. I think that's another way to mitigate it, is to own and operate the properties where the demographic has a little bit more room to cover future increases in inflation. And it's the thing too is that it's not just, oh, hey, rents are going to go up, so all the greedy landlords are going to make a lot of money. Insurance is probably going to keep going up. Wages are probably going to keep going up. Property taxes are going to keep going up. A lot of that increase gets eaten up by expenses.
Yeah, and in terms of the affordability and I remember your screening list, do you actually redo the affordability during the actual ownership period before deciding on rent increases for tenants?
That's a good question. No, not really, because once we own the property, we have real-time data on demand, right? So when we're buying a property and screening it, we're trying to predict demand. We're trying to predict affordability. Once we've owned it for a few years, we have real-time day-to-day experience with the actual demand. At that point, we switch to, well, what are our comparables doing? What is their vacancy? What are they asking for rent? What's their performance? And then we adjust accordingly. So yeah, so once we own the asset, it goes to real-time data. When we're screening it, when we're trying to predict, that's when we look at the affordability. And you'll get instant feedback. If you're asking, even if you've owned a property for 5 years and you try to jack rents up to a level that's unaffordable for the market, you're just going to see fewer applications and you're going to see your vacancy go up. So you'll learn real fast if you're pushing too hard.
No, yeah, I was just thinking with that KPI, the renewals, where I guess if you see, hey, the median income just jumped 10K in this specific zip code, then you shift that KPI a little bit more towards the increases. But if that median income has stayed the same on the affordability and on the next during renewals, you say, hey, you know what? Renewals is more important. Don't raise the rents on this, property.
Yeah. The challenge is median income data is very lagging. By the time you get it, it's a year or 2 or 3 years old. So just that real time, what are the comps doing? What's the feedback from the 10 people that walked in your office this month or week? That is a much better guide than median income data once you get in, because again, that data tends to be a year old at best. So
Gotcha. And then I guess this is the last question. Any change? It seems 2025, you're very optimistic potentially to do multiple acquisitions.
I hope so.
Any change to if you do get multiple LOIs accepted? Any thoughts of doing a fund, or you're still of the nature of just doing individual deals?
Yeah, there's pros and cons to each. We still lean towards individual deals because it seems like most of our investors like the ability to know exactly what market, what asset their money is going into, and what the expectation is for that investment. And then also, one of the potential downsides of a fund is it tends to, and there's some ways to mitigate this by structuring it with capital calls and all that, but it tends to put a little extra pressure on the sponsor to just go out and buy something and get a return and get things moving. And we are very intentional about trying to make sure we have no pressure to do a deal. No deal is better than a bad deal. So we would rather go a long time without one and make sure we can wait until we truly do believe it's a great deal. Not to say we never will do a fund. And then again, the same thing, deal volume's been so slow this past year. Funds tend to work best when there's a lot of transactions happening, where you can buy and sell and you have that volume and you can predict, yeah, we'll probably have 3 deals in the next 5 months or whatever. Whereas right now that hasn't happened yet. And we wouldn't want to either get people all excited and say, all right, we're doing it, or actually raise the money and just have it sitting there and putting pressure on us to go buy something.
If you do a fund, you could do a cheesy, opportunistic fund, once in a lifetime.
Well, and that's the thing, is that was like a year ago. Everybody and their mother went out and raised an opportunity fund and a distressed this fund and a distressed that fund. And guess what? Those funds haven't really done much. They haven't been able to. So,
And a lot of them were actually a sneaky way of just doing capital calls, like avoid.
well, that's a whole nother topic. Yeah, and I could name some sponsors that most listeners would know, but where, yeah, they're putting out these preferred equity debt funds where you earn 15% or whatever. And what they're not disclosing is that they're actually just using that money to postpone the inevitable on their own deals. And they're not disclosing that. And I know that's happening with some sponsors for a fact, because I know some of the behind the scenes for those sponsors. And it's not that's, and actually, if your property needs additional money, it's safer and a better business decision to go raise that money yourself and control it yourself, and as opposed to have a third party come in there with hooks and strings. The problem is when you're not disclosing that to your investors and you're pretending that you're not having to do capital calls and that you have no distress, and you're making it look like this money is going out to other people's distress, when in reality you're just using it to pretend your own portfolio is in good shape. That's what the problem is. So again, it's actually a great business plan, but it's being misrepresented, and that's where the problem lies. So you're 100% right.
And I remember you were the one that always, like on our first ever call, you're the one that taught me, like, hey, just be careful of where the cash on cash is like 8% year one, because then it's like they can only pay that if they overraise. So it's amazing how the tricks continue. And then recently, and I've been kind of warning investors that be very careful with the deals where you see like 14, 15% prefs. You're like,
Oh,
there's something very wrong.
I know, agree 100%. Yep.
And then the other thing I wanted to mention, it's funny, when I started as an LP, the ads that I saw from at that time in my feed are now a 24/7. It's a complete 180 where I don't even recognize any of the names of the new syndicators raising on the Facebook. So be very careful of getting into these deals where you see like a Facebook ad and then that's the credibility you use, because really Facebook will take your money, but that doesn't have nothing to do with track record at all. The amount of new
Nope.
indicators I've seen is just absolutely amazing. And I have a strong feeling that a lot of syndicators that are currently in the middle of burning a lot of investor bridges will be rebranding and remarketing with a very clever new name.
Yeah, unfortunately, that's exactly what tends to happen. Yep.
And
Or
that's
they go to a different asset class. And now I can't tell you how many times I've seen it. I can think of one in particular that we're a multifamily sponsor, and now all of a sudden they're oil and gas experts syndicating oil and gas investments. And like,
and ATMs and
yeah, and I'm like, really? You guys know what you're doing? And oil and gas can be a great investment. I
yes.
like nothing against oil and gas, but someone who was a multi. If I went into oil and gas next month and put, you should not give me the money. Yeah, I'm gonna research it and do the best I can to understand it. But the fact of the matter is, there's no way I could possibly fully understand that industry. And the people I know who are in that industry and successful will tell you, you think there's fraud and lack of transparency in real estate. That ain't nothing compared to the oil and gas industry, because it is so opaque up to what's really going on that it's tough. So yeah, whenever I see that kind of stuff, it's like, and there is such a thing as a legitimate pivot. Hey, you know what? This asset class isn't working as well. What's one that is? But that's got to be done right to be successful.
Yeah, it takes time, right? It takes time to learn.
Yeah.
It takes time to learn ATMs, takes time to learn oil and gas. It just takes time. So if you're doing the switch in 6 months, definitely some question marks. I would strongly encourage anybody to follow Andrew, especially on LinkedIn. You definitely post some very colorful content. I remember one of my favorites was that you said that you find a strong correlation between how stupid the thumbnail looks and
Yeah.
I love that one. And then the funny part is, I was like, the first time I was like, maybe I should do thumbnails in my thing. I was like, let me just do my headshot. I don't want Andrew making fun of me. If he ever sees this, I don't want Andrew to be like, that looks really stupid.
The face I'm talking about,
Yeah,
that kind of stuff. It's no.
what are you doing? Just I don't know. But hey, they get the followers, and I'm blown away with that stuff. But Andrew, why don't you tell people where to find you? There's not many operators I actually recommend these days at all, but you're actually one of the few that I consistently be like, hey guys, I learned from Andrew's the man when it comes to this stuff. Plus, you're one of the only ones that really offers 506B because you haven't burned your investors over and over again.
Yeah.
Because you can't do 506B if you burn your investors. And we follow a lot of my current underwriting, the way I project my 13 to 15% IRR, all comes directly from the way you taught me. And I can't think, I hope we do like a mastermind reunion one day, because that was still
Well, that might be fun. Yeah.
greatest investment I think I ever made was that mastermind. So Andrew, please tell them where they can reach you. And as always, big thank you for coming on.
Yeah, no, it was good talking with you again. Like you said, LinkedIn's I don't do social media other than LinkedIn. I'm not on TikTok or Instagram or Reels or any of this stuff. Just not going to do it. But I am on LinkedIn. And if you reply, if you comment on it, that is actually me replying to you. It's not AI or virtual assistant or anything like that. That is me. So it's a good way to have a conversation about a topic. And then, of course, you just are, if you Google Vantage Point Acquisitions, our website comes up. It's vpacq.com. And there's a couple different ways to connect with us on there.
And Andrew, I do want to point out, we're actually in contract for a hotel portfolio that comes with a private beach. So,
oh, nice. Jersey, or where's that?
Yeah, which has some great surfing. So you are officially, I think in 2025, we're going to be doing our second wealth retreat. So I'm officially inviting you, if you're interested, come down, get some great surfing in, and we'll have the retreat actually on the beach. I think it's going to be pretty.
Oh, nice. We'll do it in September. That's when the East Coast has the best surf. So
I will plan according to your schedule. Well, I actually got to plan it according to the hotel schedule, but that actually works really well because that's the end of the season for in that area.
Makes sense. Yep.
All right. Thank you so much, Andrew, for having me on.